Happy Thursday, everybody. Welcome to another episode of Market Update, where we discuss leading financial and economic developments in Asia, Europe, and North America. My name is Tony. Let's jump in. And first up, US President Donald Trump's push for a sweeping economic overhaul through massive tax cuts and ambitious defense spending has received pushback from some fiscal conservatives and spooked some in the market. At the heart of Trump's legislative agenda is a proposed extension of the 2017 tax cuts, the so-called biggest tax cut in American history, combined with deep spending reductions and new incentives aimed at households, businesses, and the military-industrial complex. But the plan, which faces some resistance, risks ballooning the US national debt by more than $3.3 trillion over the next decade, according to the Committee for a Responsible Federal Budget. This means the debt to GDP level of the world's largest economy would jump from 98% to 125% by the end of the period, a level well in excess of the previous high reached in the aftermath of the Second World War. Trump's team says the legislation, along with pro-growth policies such as lower taxes and deregulation, will help halve the US's yawning fiscal deficit, which stood at 6.4% as of 2024 to just 3% by the end of his term, though it is unclear whether this will be achieved or not. Markets are already flashing warning signs, however. US government bonds and stocks fell in trading yesterday. In addition, the 30-year Treasury yield reached its highest level since late 2023 in evening trading in New York, extending a multi-day rise. The S&P 500 dropped 1.6%, with more than 95% of its member stocks ending the day lower. Investors are concerned about the US fiscal outlook. The affairs were also reflected in a weak $16 billion auction of 20-year treasuries, which were sold at their highest interest rate since 2020. During the pandemic, Moody's has stripped the US of its AAA credit rating, something we've covered on Market Update earlier in the week, citing unsustainable deficits, while the International Monetary Fund has warned that American fiscal imbalances are, quote, too large, end quote. Now, a lot of this is being negotiated in real time, so by the time of viewing there may be some changes, but as of writing, Trump's bill aims to permanently extend key provisions of the 2017 Tax Cuts and Jobs Act, including reductions in individual income tax rates, an expanded standard deduction, and a bolstered child tax credit. New features would exempt tips and overtime pay from taxes and increase the deduction cap for state and local taxes, SALT or SALT. At the same time, the plan would impose new taxes on university endowments and private foundations while omitting earlier Trump proposals to raise taxes on hedge fund and private equity income. Further complicating matters, Trump unveiled a new $175 billion initiative to develop a so-called Golden Dome missile defense system, a next-generation shield intended to protect the United States from ballistic, hypersonic, and cruise missile threats. Modeled loosely on Ronald Reagan's Strategic Defense Initiative, the plan includes land, sea, and space-based technologies and has already triggered backlash from China, which accuses the US of fueling a new arms race. The Pentagon has submitted preliminary blueprints for the system. Although the administration touts it as a critical national security measure, the Congressional Budget Office estimates that space-based interceptors alone could cost up to $542 billion over 20 years, with unclear returns given technological and strategic uncertainties. As lawmakers scramble to finalize the tax bill, signs of market discomfort are multiplying. This week's Treasury auction drew lackluster demand, especially for longer-dated bonds. The bond sell-off is a clear signal that investors are re-evaluating US creditworthiness amid fears that the combination of tax cuts, increased defense outlays, and minimal offsets could send deficits spiraling. Next up, we move to Asia, and it is not just the US that is feeling this pressure. Yields on Japan's longest-dated government bonds soared to record highs on Tuesday after a disappointing debt auction deepened investor concerns over demand for the country's sovereign debt. The 30-year bond yield climbed to 3.14%, while the 40-year yield surged to a record 3.61%, marking a dramatic 0.17 percentage point rise. The 20-year bond yield also spiked by 0.15 percentage points to 2.56%. The moves were triggered by a notably weak bond auction, with the tail, the gap between average and lowest accepted prices, widening to the largest since the late 1980s. Tokyo-based traders pointed to fears over the Bank of Japan's tapering of bond purchases, looming economic risks from US trade tariffs, and Japan's debt burden, which exceeds 200% of GDP. So if you thought the US had a high debt-to-GDP ratio, look at Japan. Investor anxiety is growing that the shift in Japanese bond dynamics could ripple across global markets. Quote, "The sharp moves risk contagion and further weakness in the long end of global bond markets," end quote, said Mike Riddell of Fidelity Investments. Rising yields may incentivize Japanese investors to repatriate funds, straining other bond markets too. Market participants are also urging Japan's Ministry of Finance to adjust its issuance strategy. Quote, "They should stop issuing long-dated bonds until volatility drops," end quote, said Mark Dowding of RBC Blue Bay. The Bank of Japan, meanwhile, is reviewing the impact of its policy normalization, with several institutions urging it to halt tapering of super long bonds ahead of a key June meeting. Adding to the uncertainty is the fragile political standing of Prime Minister Shigeru Shiba. The approval ratings low and no progress on tariff negotiations with the US. Analysts warn that desperate pre-election fiscal promises, including tax cuts, could further strain Japan's concerning fiscal balance sheet. The world is going through tremendous change. We have entered a new period of global uncertainty. If you want to be on top of the most important developments as we move into this new era of change, consider subscribing to Market Update, hit the bell notification icon, and you will be. And if you're getting some value from today's episode, don't forget to hit the like button. And finally, for today, we move to Europe. The European Union has sent a revised trade proposal to the United States, aiming to reinvigorate flagging transatlantic trade discussions and avert a looming escalation of tariffs. The updated offer, delivered to officials in Washington earlier this week, includes a series of concessions and cooperative initiatives designed to appeal to President Donald Trump's administration, according to reports by UK-based The Financial Times and US-based The Wall Street Journal. The new EU paper addresses US concerns by proposing gradual elimination of tariffs on industrial goods and non-sensitive agricultural products. It also incorporates broader themes such as labor rights, environmental standards, economic security, and mutual investment opportunities into sectors like energy, artificial intelligence, and digital connectivity. While formal talks have yet to begin, the EU's executive arm is signaling a willingness to strike a, quote, balanced and mutually beneficial deal, end quote. However, sources caution that the European Commission would require a formal negotiating mandate from member states before launching official discussions. Despite this step forward, EU officials and several member countries remain skeptical of the Trump administration's true intentions, writes US-based Politico, citing unnamed sources. Many in Brussels fear the US is more focused on advancing unilateral trade objectives than forging a cooperative agreement. In light of this uncertainty, the EU is also preparing countermeasures should negotiations collapse. The bloc has drafted plans to impose retaliatory tariffs of up to 95 billion euros, $108 billion worth of US goods if trade tensions escalate. Earlier this month, the EU agreed to pause a separate set of retaliatory tariffs for 90 days after Trump reduced existing duties on EU exports to 10% from 20%. That truce, however, remains fragile, particularly as Trump has threatened additional levies on semiconductors, pharmaceutical products, movies, and aircraft components. According to sources speaking to UK-based Reuters, the revised EU offer is a response to a US proposal previously submitted to Brussels, which one EU official characterized as, quote, a wish list of unrealistic demands, end quote. The EU remains firm on rejecting any proposals that undermine its regulatory autonomy or tax sovereignty, particularly in areas such as digital policy and value-added tax, VAT. Brussels argues that VAT is a non-discriminatory tax structure uniformly applied across all goods. In addition to tariff-related provisions, the EU paper includes proposals for mutual recognition agreements, food and agricultural standards, public procurement access, digital trade rules, and origin requirements for goods. It also outlines joint responses to global challenges such as steel and semiconductor overcapacity, investment screening, export controls, and the competitive pressures on civilian Australian aircraft manufacturers. Notably, the document leaves room for further announcements on procurement and investment cooperation, with political-level meetings expected as early as next month. Though the Trump administration has struck recent trade deals with the UK, EU officials remain cautious. They see little in these agreements to suggest a clear roadmap for resolving outstanding transatlantic issues. For now, both sides are engaged in exploratory discussions, wary of failure, but not yet ready to walk away from the negotiating table. Okay, that is today's episode of Market Update. Thank you so much, everybody, for watching. Have a good Thursday, and I will see you all tomorrow.